Hello everybody. Welcome to the Discord. Today, first class for Sunday. So we're gonna be talking really quickly about the basics of trading. It's gonna be a quick video, but we're gonna go through different points. What is trading about? How does trading work? What are the different asset classes? The different types of trading? What makes a trader profitable versus unprofitable? And how to read a candlestick. And we're going to finish with some, not all, but some of the tools that you can use as a trader. So without further ado, let's get started. The first thing we need to go over is what is trading about. So if you were to be asked what is trading about, you would need to answer that trading is about buying and selling certain assets at a given price. All right. The whole purpose of a trader is to learn how to buy at a price that is lower than the price which he intends to sell. Obviously, right? Think of it like a merchant. You want to buy, let's say you're a merchant and you want to buy your products from, I don't know, Iraq because it's cheaper in Iraq, and then sell them in America, for example, right? But the difference is that the markets are centralized and the prices, except in some certain cases of arbitrage, the prices are globalized, right? They're the same prices or they're the same charts. You can't really cheat that way and just buy low from a certain company and then sell to another company. The prices are globalized, right? The markets are universal. So what you want to do, instead of buying from a certain place and then selling to another place, you're buying a certain asset and then waiting for the price to go above the price where you bought it from, and then sell it. Or you can do the opposite as well. You can sell and wait for the market to go back down and then buy, which we call shorting. There's two different kinds of positions. There's longs, right, which is basically buying, and there's shorts. Shorts are a bit more complicated. Shorts, in short, is basically the action of buying a certain asset at a price. What you're doing is borrowing a certain number of assets. I'm going to use Bitcoin because it's simple. Let's say you want to short one Bitcoin. What you're doing is you go to your liquidity provider, which we're going to talk about a bit later in the video, and you say, okay, I want to short a Bitcoin. So what the company is going to do is it's going to lend you a Bitcoin with the only contract being that you need to give back one Bitcoin, right? So what you're doing is you're receiving a Bitcoin at, let's say, $100,000. You're instantly selling it. The moment you receive it, you sell it, and then let's say you were right and you shorted the market from 100,000 to all the way to 90,000. So 100,000 to I can't write. To 90k. So that's a 10k difference to the downside, right? So what happens is, let's say you want to buy it back at 90k. What you do is you buy back your Bitcoin for 90,000, which you sold for 100,000. You sell it back for 90,000, and the difference you get to keep, because all you have to do is give back the company. You give back the Bitcoin you bought, right? So this is how you make money selling the market. Okay, longs are obviously easier. You just buy. But those are the two different ways you make money in the market. And traders, what they do is they try to predict the direction the market will take and where and when will it take it. So that's your whole job as a trader, right? That's the whole sauce, the whole game of it is to learn how to predict market movements and, in short, kind of see into the future. We're going to go into more details about how you do this and what's the real approach to being profitable constantly in a bit. So the first thing we need to know is what are the different asset classes you're going to be trading as a trader. There's 4 different asset classes, all right? Those 4 are the crypto markets. I think they don't really need an introduction, right? You have the Bitcoins and the Ethereums and whatever other crypto there is, Solana, Aave, whatever. Then you have the Forex markets, which is Forex is short for foreign exchange markets, which is basically the market of monies. Okay, so different currencies. For example, you're gonna see a pair that's called USD CAD. For example, it's the dollar against the Canadian dollar, and then you have Euro USD, the Euro dollar, the Euro against the US dollar, and you have the pound against the dollar. And what's interesting to know here, if you see, it's always something against something. That's how the markets work. Because let's say I'm gonna go back to my analogy of the crypto. One Bitcoin is always gonna be worth one Bitcoin, right? Logical. $1 is always gonna be worth $1. But the question is, how much is that Bitcoin worth against something? Usually the main comparator is going to be the American dollar. For example, that's why you hear, for example, oh, Bitcoin just passed 100K, right? Because they're looking at this pair. Why I'm telling you this, guys, it's because there's different ways to trade. For example, Bitcoin against Ethereum is different from Bitcoin against US dollar. What's important to note is that there's always going to be the same pattern. Let's say you trade Bitcoin against the Ethereum, right? What's going to happen is that if, let's say, Bitcoin goes up and Ethereum goes down, right? That particular asset, which is Bitcoin Ethereum, is going to go up a lot, okay? Because it's logical, right? If I have one Bitcoin against $1, for example, and my Bitcoin is worth $10,000, but then the dollar goes down and the Bitcoin itself goes up, what's going to happen? The price of the Bitcoin is going to go up and the price of the dollar goes down. So the whole Bitcoin to dollar goes up. It's the same thing. And the opposite is also true. In that example, let's say you have USD CAD. Let's say the dollar goes down, the value of the dollar goes down, and the value of the Canadian dollar goes up. What happens is that pair, USD CAD, is going to go down, right? So very, very important to know that, okay? Now, let's just continue with the other asset pairs. We have the futures. Let me just go with stocks first, because it's simpler to understand. Stocks, obviously, I think most of you guys know what stocks are about. They're different companies, usually from the American stock market, but not limited to it. So you have basic stocks like Tesla, Nvidia, Apple, whatnot. And what you guys need to know is the stock market is open from 9:30 New York time all the way to 5. You have extended hours, but they're very limited and they're not really relevant. The Forex market itself is open 24/5. Okay, so that's 24 hours of the week, of the day, from Monday to Friday, and it closes at 6 p.m. on Friday, if I'm not mistaken, or 5. And then you have the futures, which is opened 24/5, just like Forex. However, there's a 1 hour rollover, so the market is closed from 5 p.m. to 6 p.m. This is all in New York time. And the crypto obviously is open 24/7, even during the weekends, with no rollover, no breaks whatsoever. So this is for the different asset classes. The futures one is, in my opinion, the most interesting. Futures contain 3 types of assets. You have the commodities. Commodities are real life objects, tangible, that you can buy and sell. So commodities include, for example, gold, silver, oil, whatnot, but it also includes more uncommon stuff. Like, for example, you can sell pork livers, or if I'm not mistaken, cows, or the price of cattle, or the price of corn, or the price of wheat, etc., etc. It's a very, very big market. And then you have indexes. Indexes, not to be mistaken with the stocks. Indexes are baskets of different stocks. So, for example, the most famous index is going to be the NASDAQ. So, NASDAQ, which is the US Tech 100. So, the 100 biggest tech companies in the United States. Then you also have the Dow Jones, so the Dow Jones, or US 30. And then you have the S&P 500, the Standard and Poor's. So this one's also a very, very famous index. So all three of those indexes, they're not mistaken. They're not to be mistaken with stocks because they are from the futures family, but basically they're baskets of stocks. So very important to know that. And then you have bonds, which is basically lends or interest-based loans that you give or that people give to governments, right? So let's say you give a bond to a government, you lend them a bond of $10,000, and they have to give you back 10,100 at the end of the day, for example. So it really doesn't change a lot, all of those markets in the way that we are trading. So on TradingView and all the different stuff that we're going to talk about down the line, it really doesn't matter what you trade. There's differences between all of those, which we're not going to talk about today because they're very subtle and it requires a better understanding of the market and stuff. But they all have some sort of differences. But in terms of purely how they're traded, they are all traded on charts with different patterns and different strategies to trade them all, but they're all pretty similar. So this is for our first part. So those are the different asset classes. Feel free to take a screenshot or take notes. Now we're going to go to the difference in types of trading. So let's just start from the left and go to the right. So at the smallest scale, we have the scalpers. So scalping, as it's said in the name, is taking small bits of the market, small percentages, in a very short amount of time. So from seconds to an hour. By the way, guys, those times, they're not necessarily 100% accurate. They're just here as an estimate, right? As someone that holds a position for a month, you're not going to be calling him a day trader. But if, let's say you hold a position for 25 hours instead of 24, you're not going to be necessarily in trouble. So it's just important to know that those time frames are just here as an example and to give you an idea. So for scalping, we have seconds to mostly an hour. It's rare that you're going to go above an hour as a scalper. But basically what it is, it's like I said, taking short amounts of money from the market, taking small movements with a high margin. And the cons of this is that it's very quick. So you make money really fast. Usually when people think of trading, they think of either scalping or day trading, meaning you just go on your computer, make money, and then you leave to do whatever you want. The 20 minutes day of work or 30 minutes day of work. That's kind of from scalping. It's this kind of lifestyle. If you're looking for that lifestyle, you want to be a scalper. It's the most money you're going to make out of all of those, and it's the most consistent. I know some people might argue with me about this, but what I mean is that if you're profitable, it's going to be the most consistent in how much you can make in a month, because the more you trade, the less one trade is going to impact your month, right? So it's pretty logical, and you're going to understand it a bit better down the line. So for me, it's the most consistent, all right? The con is it's the most difficult by extremely far, okay? Being a scalper takes years of experience in all of those three areas, and it takes a lot of discipline, a lot of things to follow, and it's really not for everyone, but it's there. And it's like I said, if you learn to do it, if you find the way to do it, you're going to be really happy with your life. So then we have day trading. So from an hour to 24 hours, day trading is also referred to as intraday. It's very important to know that sometimes in trading, the terms kind of mix together. So someone could be saying I'm a day trader and they're actually a scalper. Someone could be saying I'm a scalper and they're actually a day trader. The terms sometimes mix. Like I said, day trading, you can also hear about it as intraday, which is inside the day trading. So basically, the advantages of this is it's an in-between between the swing trading and the scalping. What I mean by that is it's quick, it's consistent, not more consistent than the scalping, but it's still pretty consistent, and it's less difficult, it's less stressful, and it's easier than scalping. But it's also a bit less profitable, a bit more time consuming. And what I mean by that in the time consuming part is most traders do not control themselves, and most traders, because it's a very stressful thing, you're making money risking your own money, and so you're never like fully safe until you withdraw your profits. But basically what's happening is that you're gonna, if you hold a position for a whole day, you might be stressed for a whole day. You understand? For me, it's the perfect mix of stress, because swing traders, they hold their positions for days or weeks, so they're not constantly looking at their phone. And scalpers, they're in and they're out of the markets. But day traders, they can be in a position a whole day, looking at their phone throughout the day and seeing profits or losses, and it can be very, very tiring for the mind. So that's something to note. But day trading in itself, I would recommend it if you are willing to trade, and it's the step right before being a scalper in terms of being profitable and the highest level you can achieve as a successful trader. It's the step right before it. Then you have swing trading. Swing trading is probably by far the most common type of trading, especially amongst beginners, because it's very, very easy. It's pretty simple. The concepts that you learn in trading work most in scalping, in swing trading. They work more than scalping, and it's usually simpler to trade, especially for retail. So retail is the normal people, the peasants, right? So us peasants, we are called retail, and it's very, very, very easy for us to trade swing compared to scalping or day trading. So that's one thing to know, okay? What's good about it is it's perfect for part-time. So what I mean is that if you are, let's say you're in school or you're working or whatnot, and you just want to have a foot in trading, learn at your pace, whatever, this is perfect for you, because you're not necessarily trading all the time and working a lot, but at the same time, you can still make very decent profits, and it's easier than day trading. So day trading, like I said, is easier than scalping, and swing trading is easier than day trading. And it's good for beginners because, like I said, the concepts and the things you learn, they work most in swing trading. Then you have the cons. So it's inconsistent. What I mean by that is, let's say you want to make a certain amount of profits per month. Since you're holding those trades for a long amount of time, just one bad trade or series of bad trades, like 2 or 3 bad trades back to back, can mess up a whole month, and can mess up one bad month can mess up a whole year, right? And vice versa. If you have a good series of trade, it can change a month, and 1 month can change a year as well. So it's very important to know that. And then it's easy to FOMO. What I mean by that is, since you're waiting for setups for days, literally, it's easy to jump into setups or trades that you're not fully supposed to enter in, because you're tired of waiting, because you want to feel that thrill of being in the trade. So it's easy to FOMO. Whereas scalping, you have a million opportunities in a day, so you're not really worried about missing out on certain opportunities. It's more easier to just take just your setups. And then I would say it's easy to learn but difficult to master. What I mean by that is that a lot of beginners, they jump into swing trading and they're good, they can make some profits, but real swing traders, so the best swing traders that make a consistent living out of it, they are levels above this, and it's very, very difficult to become a good swing trader. In my opinion, it's easier to become a good day trader than it is to become a good swing trader, right? So that's not good. Sorry, it's easier to master day trading than it is to master swing trading. And then you have the last and final. You have the final type of trading, which is the position trading. So it's a month and above, years, whatever. You can call this investing as well, but pretty simple. It takes almost no skill. You could, after 1 week, you could almost have 100% win rate. It's good for additional income. If you're someone that's not really in the game of trading, or you just want to make a bit more money, you already have a work or you already have a business, this is good for you. And then it's unreliable. What I mean by that is most people are going to tell you, yeah, you're investing, it's reliable, it's better than scalping. I disagree, because the only thing that makes scalping, day trading, swing trading unreliable is the lack of skill. Whereas positions, it's unreliable because even if you're skilled, probabilities can still make you lose. What I mean by that is that, let's say I take a trade, I buy Bitcoin at 100,000 and Bitcoin decides to dump. As long as I'm not selling, I'm not in trouble. But it can take long before I'm in profits. So you're not controlling the markets, and the more it takes time, the least likely it is for you to be accurate in your prediction, right? So, however, it's impossible to lose, guys. In trading positions, there's something we call DCA, so dollar cost averaging. Basically, just putting your money in it and never selling until you're in profit. It's pretty simple. It's good for stable income, but it's very slow, right? It's good for people that wish to have like a side income from trading, but it's very slow. So those are the 4 different types of trading. And then we're gonna go to the next chapter, which is how to divide profitable and unprofitable traders. What makes them different? So unprofitable traders, so traders that do not make money constantly, at least, there's recurring patterns. So the first pattern we see in unprofitable traders is the lack of structure. What does it mean? A lot of unprofitable traders come in the market not knowing what they're looking for, not knowing why they're trading, not knowing what they're trading, what assets, what type of trading they're going to perform, what kind of trades they're looking for. Are they looking to buy, or they're looking to sell? Basically, they treat the market like a casino, and they just come in the market with their intuition, their feelings. Oh, I feel it's going to go up, I feel it's going to go down, I heard from this guy. They use news or other people's calls or whatnot, instead of going with their own structure, their own logic, their own proven statistics. And they avoid losses and sequence. What does it mean? It means that they want to win at all prices. You may think that this is a good idea, whatever, Kaizen mentality, whatever, but it's not, because avoiding losses is actually the thing that makes you lose. It's called the Murphy Law. You attract what you're trying to avoid. In trading, avoiding losses transfers and translates into moving your stop loss. When you know the market is gonna stop you out here, you're trying to avoid that moment. So when it comes close to your invalidation and the moment where you want to exit, you say, no, I'm gonna hold it a bit longer. Maybe it's gonna go in my favor. So you try to avoid losses at all costs, and you seek wins. What does it mean? It means that once the market is in your favor, instead of holding it and trusting your guts and trusting your system and making sure you take advantage of it as much as possible, you exit early. Basically, there's a sentence that summarizes this point. People lose like they're rich and win like they're poor. So be careful of that. Then you have trades for money rather than consistency. This one is pretty self-explanatory. You trade for the money you're going to make, or the P&L, meaning when you trade, you're not looking at, okay, market can go there. If I buy Bitcoin at 100,000, I know it can go to 110,000. You think, okay, if I buy Bitcoin at 100,000 and it goes at 101, you take your profits out because you're seeing money. You're seeing, oh, I made 1,000. Let me just take that money out. You understand? And it's kind of linked to the first thing of winning like you're poor and losing like you're rich. And then, does not journal to improve. We're going to go over journaling in another class, but journaling is by far the most important thing you can do as a trader, and it's probably 50 or 60 or 70% of your actual input or your work that you're going to do. You understand? So that's very important. And then you have changes approach every week. What does it mean? It means that in trading, we have strategies and models to help us predict the markets better, right? We have a statistic approach to say, okay, this is most likely to make the market go up or more likely to make the market go down. And what happens is those kind of traders, instead of letting their probabilities play out, they basically just switch strategies every time. Imagine you're playing the roulette all right? Or forget the roulette. You're playing. You're throwing a coin. You're tossing a coin. So you have 50% it falls on head, and 50% chance it falls on tails, right? What you're doing as a trader is having an advantage. It's trying to have a statistical advantage. Let's say I had a special coin that had 70% chance of falling on heads and 30% chance of falling on tails. You wouldn't bet on tails no matter what, because you know that on the long run you're going to win more with heads than you're going to win with tails, right? So it's the same thing with the trading approach. You want to have a system that has a statistical advantage, and then you just play that advantage over and over and over again. You toss the coin over and over and over again, and that advantage is going to play out eventually. So this is for the unprofitable trader. And then the profitable trader, pretty simple, has a systemic approach. Again, we are going to talk about this further. We have a whole channel in the Discord dedicated to different systems and debating about systems and teaching different systems and whatnot. Then you have back tests and forward tests. So let me just explain to you guys what's the difference between the two and how you can implement them. So back testing is the action of going back in time and looking at what the market did to then find or confirm different statistic advantages, right? Or what we call edge. So what you want to do is backtest as much as possible, because you can gain years of knowledge in months or even weeks. And then you have forward test. Forward test is basically a fancy way to just say trading, right? Doing what you're doing in a live market, trading your system in a live market. So tomorrow we're going to be forward testing my system that I have been forward testing and back testing for a while. We're going to be forward testing. What I mean is that I'm still gathering data month to month. I go, let me just show you guys my journal for August. Month to month, I go on different, you're going to see it takes a while to load because I have a million trades and there's so many different types of data I'm gathering. As you can see, I'm gathering the pair I'm trading on, if it's a win or a loss, and the type of trade I took, what was the setup. So those are my different setups. And then you have the conditions. Then you have the exit logic. I have different kinds of exit logics, how much I risked, what kind of session I traded in, and how much confidence I felt on the trade, how much profit I made, whatnot, and how perfectly did I do my execution. You want to gather data. This is part of journaling, by the way. And so let's just go back to this. And we see here trades to gather data. I do not trade to win. I trade to understand the markets better. I know it sounds stupid because at the end of the day, your target is to be profitable. But you want to be profitable by looking at winning in a good manner, not just winning for the sake of winning. You can have a very bad day and make money, and you can have a very good day and lose money. You understand? That's the whole point. It's that you're not going to win by looking at your result of one day. You want to do the right thing every day, even if on a certain day it does not work or you lose money or whatnot. Let's probabilities play out. Again, it's the same thing, right? You want to trade with the intention of doing the same thing again and winning over many trades, not just a singular trade. And then I treat losses as business expenses. That's pretty logical, but every business has their own expenses. If you have a restaurant, you have to pay for the food, you have to pay for the employees, you have to pay for whatnot. Us traders, we don't have products, we don't have margins we have to respect, we don't have turnovers, we have to give money to employees or whatnot. We don't have any expenses apart from maybe subscriptions to TradingView or different things like that, which rarely go over $50 a month. But that's one of the expenses, right? The real expense as a trader, the real business expense, is your losses, and then maintains consistency through models and playbooks. So different kinds of models and different kinds of systemic approaches and whatnot. Those are models. Playbooks are basically multiple models. So for example, to go back on my example here, what I have is a playbook, right? Think of it like models are the pages of a book, and playbooks or the whole book, right? So as you can see here, my setup, I have 4 different setups. I really like naming my setups, by the way, so that's one thing I like to do. And basically, that's a playbook, meaning it's the more advanced step of trading, because when you start, you may have one model, but your model is not going to be able to be applied on every single context. So having a playbook makes it so that you can trade different contexts, different markets, different behaviors, and whatnot. So now we're going to go into the core. That's probably why most people looked at this video. It's how do we actually trade? How do we read candles? Okay, let me just not do that. How do we read candles? It's very simple, guys. You have 2 types of candles, bullish candles and bearish candles. So bearish candles are red most of the time, and bullish candles are green. As you can see for my candles, hold on. As you can see for my candles, my bearish candles are black and my bullish candles are blue, but that's up to you. You can customize them however you like. It doesn't really matter, but just for the sake of the example, we're going to do red and green. So basically, every candle has 4 points you want to read, you want to understand. It's telling you 4 different informations. The first information it's going to give you is the price open. So where did the price start? Where did that candle start? Those candles, think of it like inside that candle, it's a whole squiggly line, you know, like those squiggly lines from the stock market and whatnot. This is what's happening inside the candle, right? So instead of having lines that go like this and you try to read price like this, it's candle by candle. So every candle has a time frame. So as you can see here, I have different time frames, 1, 3, 5, 15, 30, whatnot, 1 hour. What does it mean is right now I'm on the 5, meaning every candle I'm going to see on my chart is 5 minutes, is a little capsule of 5 minutes. So every candle has those 4 points. It has the price open. So where did the price open? As you can see, for example, this candle, the price would have opened, if you look at the right, at 105,778, right? If you look here. So that's about what? Now, this is the first information. So the price open for a red candle, it's gonna be the top of the body, which this is called the body. The strong part is called the body. And then you have the price close, which is the low of the body. For a bearish candle, it is the low of the body, and it's right here, as you can see. Then for bearish and bullish candles alike, you have the wicks. And for bearish and bullish candles alike, you have the top wick, which is the same for both, the one that's up, and it indicates and it shows where the price went the highest. And then you have the bottom wick that shows where the price went the lowest. So what does it mean actually? It means that, for example, you see this candle has a wick all the way down here. It means that at some point in the candle, the market was like this. The market had a full body. The body had reached that part. And let's say it goes back up like this. It starts going back up inside the candle. What happens is it's going to keep that trail, right? It's like a trail or a footprint of where the body was. Okay? So this is for the bearish candle. And then you have the same thing for the bullish candle, except the price open is at the low of the candle, of the body. And the price close is at the high. Then you have the top wick, which is above, and the bottom wick, which is below, right? So let's say at a given example of different candles. So I have 4 candles here. The first candle, as you can see, is bullish. So it's green. So the price opened here, okay? The price opened here. And then it goes up, and then it closes here. But it closes here, so the next candle opens at the same price, or sensibly close to the same price, right? Then this candle goes down. So it goes down without a top wick. So it goes down straight away without going up. It goes down, and then it goes down all the way to here, and then decides to go back up a little bit, right? Before closing. And so it closes right here, and it opens right here. And then same thing, this candle maybe goes up a bit above, and then it starts going down. all the way down here, right? And then goes back up, leaving that trail behind. So what happens is it closes here because it's a bearish candle, so the close is under. It's the lowest part of the body. That's the close. And then this candle opens at the same place, but this time it goes up. It creates a bottom wick, meaning at some point the candle was bearish. At some point the candle was like this. Let me just make it red for you guys. At some point the candle was like this, but then it flipped and it left a trail, which is the wick, right? So that's just basically what candles are about. I strongly advise you, if this is confusing to you, which it probably is, but it's fine, guys. We all start somewhere and it's totally normal. If this is confusing to you, the only thing I advise you to do is to go look at a market for a few minutes, right? Let me just go on the 1 minute for you guys so you might understand. This candle, as you can see, every candle here represents a minute. What happens is this candle closed here and the other candle opened here. As you can see, let me just zoom in really hard for you guys. As you can see, this candle is going to close in 4 seconds and it's going to start and it's going to open right here. Boom, it opens, and now as you can see it reverses, and then boom, it inversed again. Now it's going up, but the little trail it left here, at some point the body was here. And just look at the candle, how it moves, and you're going to start getting the hang of it in no time. As you can see now, it's going up pretty intensely, but it's going to leave a wick at some point. If it decides to go down, it's going to create a wick. Right now it's maybe a bad example because it keeps going up without stopping, but at some point it's going to give a wick, right? Very important to understand this, guys. If this is the core of trading, it's the candles. That's all you're looking at all day, every day. Very important. Okay, so now we're going to go through the tools, guys. So the different tools you want to use. I took 4 tools because the video is already long enough now. Oh my god, sorry guys. So let's just look at that. So the first tool we have, the application or the website or the tool I've been using for the whole video is TradingView, right? It's the app that you're gonna use for your charting. It's possible to trade on the app by connecting your broker, which we're gonna talk about later. It's possible to have indicators, which we're going to talk about in another video, and it's possible to backtest. So it's pretty much an all-in-one. It's probably the app you're going to spend the most of your time on. There's some alternatives, but they're not as reliable than TradingView. There's NinjaTrader, there's MetaTrader 4 and 5, and basically you have different alternatives. You also have TradeLocker. We're going to talk about this a bit later, but this is basically what's up. Okay, so now what we want to see is, so this is TradingView, like I said. Then we have brokers, right? So brokers, they're basically your link, or they're the middleman between you and the markets. You cannot trade without a broker. And brokers, there's many of them. If you want some personal recommendations, you can go to FP Markets, which is my favorite broker, which is the one I use, and you can just do your research. There's pretty much a million brokers. You just choose which one suits you best. If you want, I can give you personal recommendations based on what you want or whatnot, but this is for brokers. Then you have prop firms, which we're going to talk about in a bit. But to go back to this, you have Forex Factory, which is going to be the center for all of the news. So the markets, they work, there's a lot of news, right? And depending on what you trade, you might have different kinds of news. For example, if I trade Forex and I trade the Australian dollar, then I need to know what kind of Australian news there is. News are not the breaking news of O.J. Simpson. News are decisions from the central bank of which country or whatever, or the government decisions, the data that's given or whatnot. So those are the news. They're called fundamental trading. which is the opposite of technical trading. Technical trading is trading based on the charts, and fundamental trading is trading based on real life, what's happening in life, war, whatnot. So this is where you're going to find all of your news. Forex Factory. Then you have Notion, which is, I think, a Google app, which is for the journaling. It's the app I showed you guys here. This is Notion. And also, as you can see, you can journal your individual trades, which is what I do. I take screenshots. It's a very, very efficient app, very user-friendly, very good. This is what I recommend. You also have a calendar, which you can then see every day trade you've been having, your win streaks and whatnot. And then you have FX Replay for backtesting. TradingView's backtesting is a premium thing. You need to pay, I think, $15 a month to access it. So if you want a free alternative, you have FX Replay, which is a bit less ergonomical, but they're using the same charts as TradingView. So there is that. And then you have the most important, in my opinion, it's the prop firms. Prop firms basically are companies that are going to lend you money to trade with. I'm really summarizing it right now, but in a nutshell, those companies, depending on what company and what kind of evaluation or what kind of product you buy from them, they're going to sell you maybe an evaluation. So meaning you have $100,000. You need to pay for $100,000. You need to pay about 500 to 800 US dollars for it. And they give you that account and you need to make $10,000 on that account. So you need to go from 100,000 to 110,000 without losing 10,000. So without going under 90,000, right? So this is most of the prop firms. That's what they offer. In short, those companies, when you know how to trade, they're going to be literally the bread and butter of your trading. Right now, I'm funded on 3 different companies. I'm funded with 3 different companies. I'm funded about 600K. As you can see on this company, for example, let me just go on this account. I have 4 accounts, and 2 of those accounts, they're passed, so they're funded. And as you can see, this one right now, I have a current balance of 103,000. My withdrawal is in a few days, inshallah. So I'll cash out this much, and then you have the other account which I'm trading with right now as well, which I'm already up 1,090 and 197 in 2 days. So that's good. And basically, they're paying you real money to trade fake money, right? So this is if you want more details, we can go over this in the Discord. I'm going to give you different prop firms, which I like, which I dislike and whatnot. But what you need to remember is this is the best way to make money as a profitable trader. You don't need to invest a lot, all right? There's companies that sell you $10,000 accounts for $17, right? So this is very, very, very good for learning and for actually making money. So guys, pretty much this is all for today. I know it's a very long video. I didn't plan on it being that long, but trading is a complex subject that requires a lot of time and a lot of attention. Obviously, if you liked this video, follow me, subscribe, like the post, like the YouTube video, and share it, I guess. So thank you guys very much for watching, and I'll see you in the next one in the Discord or on YouTube.